Williams, also known as Diamond Dave, the founder of the highest paid part-time job in the World Options Trading Program. What we're going to really quickly break down is why the AMC short squeeze play is pretty much over. It's pretty much, finute or kaput, or however you want to, say it. Kind of give you my analysis of the particular play. This is not going to be financial advice. It's not investment advice. This is primarily for entertainment and also education and also information. This is just my personal perspective, right? So I want you to take everything I'm saying with a grain of salt. Don't take it personal. It's not an attack on you. It's just my analysis of this particular play. And so what we're looking at is this AMC entertainment play, ticker AMC. And a lot of people have bought into this particular play because they believe that it has short squeeze potential. So first thing we want to understand, any sustained quote unquote short squeeze, when I say sustained, I mean over 2 days, is very unlikely. One of the things that you can look at when you're looking at statistics is days to cover, which is how many days would it take for the shorts to cover their plays. Normally, you can see how many days it would take. So that will kind of give you the extent of the short squeeze. Doesn't mean the velocity of the short squeeze, but it's how long it will stay sustained. Another thing that you can understand is that most stocks trade within a range, probably 85 to 90% of the time. The 10% of the time they break out, whether it's going to be breaking out up or breaking out down. So based on your understanding of those particular things, if you believe that to be true, we can understand that any sustained short squeeze, quote unquote short squeeze, is going to be very, very unlikely. OK, so it doesn't mean that you can't take advantage of it. And we're going to kind of show this on this chart, but then we're going to show you on the chart why you don't normally see a sustained short squeeze. And a lot of times we're in this era now where people believe that any massive move on a stock is a short squeeze. And that really comes from a lack of understanding about the market, because it's more exciting to believe that everything is a short squeeze. Maybe 600, 700 years ago, people believed that, weather patterns were gods fighting in the sky. That was more exciting than just to understand it's just a weather pattern. So we're kind of dealing with that same kind of human psychology, to where if we see a stock moving up in a really, really bullish position, or, taking a lot of, bullish activity, we believe it has to be because of a short squeeze, as opposed to it's just a lot of people buying the stock at this particular time. So let's go ahead and get into it. I'm gonna kind of give you my analysis of it. So what we're looking at is AMC, right? Currently right now it's trading at around 35.78. Wanted to put this out yesterday, but was having some technical issues, so I couldn't do it. So what we're gonna do first is we're gonna go to a 5-year, right? So I want you to see this whole thing in context. So we're going to a 5-year starting around 2014. It's kind of smushing our time period, but I want to show you this first, right? So what I'm going to do is I'm going to do basic technical analysis. So what do I mean by basic technical analysis? I'm always trying to find support and resistance, right? I don't care about anything else, because to me, if you can't find support and resistance, I'm trying to figure out what else you're trying to look for, because what you want to kind of figure out is that where is the buying? Where does it kind of get, I would call exhausted, right? And then where does the buying kind of come back in at? So looking at this particular 5-year, I'm going to just draw out what I think is just some basic support and resistance lines. Okay, do I want to use that color? Let's use that color and then make sure I have the right. We'll try this. Okay, that's a work. Okay, so I want to do a basic support around 35, 36. Sorry, a basic resistance. And then we're going to do another support here at around the $20 mark. And that's also resistance here. And then we're probably going to do like another support around here, around this $13 mark. And then we may also do another one around, I don't know, what's this, like $2. Now, what you're seeing is that this is 5 years of trading activity, right? So we got the whole 5 years here. Over 5 years of trading activity, what we saw was that when this particular ticker hit around $36, $35, $36, it sold back down. Let me zoom in a little bit. We're seeing that. Hit around $35, $36, it sold down. And this was around 2015. Hit this number and it sold off, right? Now, we don't necessarily know the story behind that, but we know from a technical standpoint, it sold off. Then we have the same thing here around 2016. It got around that same number and it sold off, right? And it really sold off really, really hard So I wouldn't, this was a support. It pushed through this particular support of this $20, right? So this was a support. It pushed down through this $20 support and started to fall down around this $14 support, right? So we saw it hit this 36 and sold off. Now we in 2017. I want to stop right here and I want you to understand something from a contextual standpoint. In 2016, 2017, 2014, 2015, the marketplace to go attend a movie was much more favorable than it is currently right now today, right? We got much more streaming activity. We have more opportunities for people to watch movies at home. A lot of stuff is being pushed directly through some type of streaming platform as opposed to going to a distributor, then going to a movie theater where they can forward it, and then now getting pushed to an on-demand platform, right? That used to be the process. So you take a guy like Tyler Perry, he put a movie out, he hit his particular markets through his relationship, I think, with Touchstone, right? They're the distributor. Then once they hit those particular movie markets from the physical standpoint, they move it to an on-demand platform, right? That may be a network. Then once they get on the on-demand platform, then they can move it to more of a second tier on-demand platform, like maybe like a Netflix or something of that nature. Then you also got the third party on-demand platforms that you sell it off to, like maybe AMC, the television platform, or home box office or Cinemax or something of that nature. So you got to understand there was a lot of levels to this. But at this particular time, the movie theater normally would get the actual movie first if it was seen as a valuable platform or a valuable piece of content, I meant to say. So if it was a top tier movie, it would normally get forwarded first and then go to the secondary platform providers, right? So even in that particular environment, what we saw was that 35.36 was a really hard resistance for this particular ticker. Then what we saw in 2017, for whatever reason, was probably because of bad financials and a lot of debt. It started to sell way below that $20 support, and it traded with pretty much within a range between $15 and $20. And then what do we see even before COVID is it started to push under that $15 mark and started to go down into the, to the lower teens. And this was even before COVID. We're looking at 2019. So right before COVID hit, which is 2020, this ticker was trading at around $5. Okay, so that's the reality. So then what you had, right? So what we're going to do is we've already established 35.36 was that support, right? So what you had was, let me clear the drawing off. What you had was pretty much, this was the historical story of this particular stock, right? And then what you had in early, 2021 is a lot of people started buying into it because it was going to quote unquote short squeeze. And what we saw was that, a lot of people bought into it. They got into the early teens, the low teens. It sold off. It traded around, let's say the $10, $11 mark, and it started to move up, from a very bullish standpoint. Now, a lot of people believe that this was a short squeeze, but it really wasn't. It was demand on the stock, right? And so what you saw was a lot of demand on the stock, trading in the 20s, right? It closed at 26. It gapped up to 31, closed at 47. It kept gapping up, but then what do we see here? It got to a it got to a top of around $61 and it sold back down. So let's go to the 1 year so we can get to the daily chart, right? And so what we're seeing is that, let's go to this particular line. Can we put a line here? What we're seeing is that there's a line here, got around that $60 and it sold off, right? I wouldn't necessarily call this a support, but we'll just make it like a preliminary support, and got around about this $35 and it bounced. So let's zoom in on here. So what we see is that it got around this $60 mark. It sold off again. It moved back up and it sold back down again. And then it sold all the way down, right? Till it hit that $36 support, 30 something dollar support, bounced. And now we're pushing back down on this support again. So the goal is to see whether or not it goes through here, right? Or it bounces back off and goes back up, right? But what do we know historically about this stock before it ever got to $60? That the 36 was pretty much a resistance point for this particular play. $36 was a big resistance historically, right? Even though we had this phenomenon where it moved up because a lot of demand on the particular ticker and people willing to buy it at higher prices. What people have to understand is that in the stock market, if you're willing to buy it at a higher price, somebody will sell it to you at that price. Once they realize I got a big enough pool of people willing to buy this ticker at higher prices, they'll sell it at higher prices. Why? Because you're willing to buy it. But what we found is that When this ticker got around $60, people were not willing to buy it at a higher price. So this is the whole flaw in this narrative that this thing is going to move up. I want you to understand something. Why do we get price resistance at $61? That's a question I want to ask you. And especially if you are a proponent of this play. Why did we get price resistance, which is an emotional resistance, because all buying behavior is emotional, whether you're a male or a female. I know a lot of males think they're logical. They buy consumer goods like everybody else. So all buying behavior is emotional. So why did at $61 we get buying resistance? Why do we get it? It is because people don't believe this particular ticker is worth more than $61. But I thought this ticker was going to $5,000. I thought it was going to $100,000. I thought the true price of this was $2,000 a share. So if I really truly believed, I had a high level of conviction that I was purchasing a ticker that had a true value, right? That was 10x or 20x or 30x of what I was currently purchasing it at, I wouldn't be mad if I paid an extra $100 for it. So if I believed I was purchasing company XYZ stock, right, at $50, because I believed its true value was really $1,000, and I believed that the market eventually would realize this, and I would be able to buy shares at $50, but they would be valued by the market at $1,000. I wouldn't trip by paying an extra $50 for it. Why? Because I really believed it's worth $1,000. So what the market has done is, I tell people all the time, the market will show you who you really are. It's exposed that these people really don't believe that AMC is worth this high price point that they're trying to sell everybody else on. Why? Because they wouldn't pay more money for it. Because it stopped out at 60, came down, moved back up, and met more price resistance. And then it sold all the way back down again. So what we had a lot of people getting out of this play here. Because if they believed that this particular ticker was going to continue to move up, why did it sell off from here? It's not the funds that are doing this, because I want to explain something to you. We're operating under the premise that is being told that retail owns 80% of the float. So if retail owns 80% of the float, then retail sold this off. Because if retail owns 80% of the float and you're buying AMC at $35.79, who's selling it to you? Because retail owns 80% of the float. So if retail owns 80% of the float and you're buying AMC at the current price today, then who sold you the shares? Who did you buy it to? I'm sorry, who did you buy it from? So what we're seeing is that they don't really believe that this thing is worth more than what it's currently buying and selling for right now, currently today. Because if they did, they will go and buy it at a higher price point. So let me explain something to you. So now I want to really give a disclaimer. What I'm explaining to you right now is 100% entertainment. I'm not describing the situation that I was ever involved in. I'm not describing the situation that I'm trying to propose that somebody should engage in. What I am proposing to you is a hypothetical entertainment situation. I just want to give a disclaimer first. This is how you could drive the price of this particular company up. And it's not anything new. It's something that funds do all the time. It's what people call painting the tape. Let's say I'm in hedge fund A and a member of my particular program, K. Alexander, is hedge fund B. And we control a certain amount of shares, but we want to drive the price up. This is all you have to do. All I have to do is put a bid of the shares at a set price. So let's say hypothetically, I put the bid of the shares I bid $100. K. Alexander, right? She puts an ask of, let's say, $95, right? So she asked 95, I bid 100. The current price of that particular share is 50. You know what that'll do? It'll drive the price up. Why? Because I'm willing to pay more and I'm willing to pay over the current ask, but she set the ask at a very high price. Now, Kate Alexander has a controlling interest of shares. She controls the majority of shares in the market for this particular ticker. So then what we do is she puts her ask, right, way above what the current ask price is, and then I put my bid above her ask. So what do? We're going to push the price up. Then I buy enough shares from her at that price to where now I have the controlling interest. Then she does the exact same thing I did, right? She puts her bid way above my ask, right? What does it do? It pushes the rest of the market up because she's willing to buy higher than the market. I exchange those shares with her. We rinse and repeat, and we just keep doing that. What do? We just keep pushing the price up. And as long as we are willing to buy over what the current market value is, and we control those amount of shares, then we'll just keep pushing the price up, because nobody's going to sell at a much lower price in the market, right? If they know they can get a certain market price for it, and we're going to set the price of the market, because what we're going to do is we're going to go in there and bid over the market. I used to deal with this when I was a Facebook media buyer. Fourth quarter, Facebook would set a bid on ad inventory, and people would come in and they literally would bid 30 and 40% over that particular ad, so they would control all the inventory. There was nothing that you could do about it unless you were willing to fight them out for those bids. So you just had to get out of the auction. So with the market being an auction-based scenario and retail controlling 80% of the float, if they control 80% of the float, it should be very easy for them to push the price up. What do they have to do? They need to go in, and instead of trying to buy this particular shares at $35, say that you want to buy the shares at $100, right? Put a $100 put a $100 bid on the particular shares, right? So bid $100. So then what'll happen is all the volume will go to you because the current price is $35.21. So show that you're willing to pay over what the particular ask price is with your bid, instead of buying at the particular price, because you shouldn't have any issue buying over that particular price. Why? Because it's going to $1,000, or it's going to $5,000, or it's going to $100,000. So you shouldn't have a problem with that, because even though you paid $100 a share, it's going to the actual increase is going to be so exponentially greater than what you paid. It shouldn't matter that you paid an extra $70 for it, right? So that's what you have to understand. The mentality that I'm going to buy as it moves down, but I'm benefiting the particular situation, or I'm not going to sell, but I'm going to hold it, that's not going to move the price up. And as we see on the chart, people are actually selling this. So if nobody was selling it, we wouldn't have the volume that we have on it. And what we would have probably is it just trading sideways. You know what I'm saying? So we wouldn't have this type of movement on the chart if nobody was selling, but they were just buying. So if nobody was selling and they were just buying, then what do we mean? That will push the price up. But it's easy to push the price up on this. All the people that are proponents of this play, just go into your particular brokerage account and set your ask at $100, or set your ask at $500. And then the market will move up to that new price, because the market's going to always try to seek equilibrium. So the market's going to always find equilibrium from a supply and demand standpoint. So if you tell suppliers you're willing to pay 300 times more than a particular price, they'll move their price up to match you, because they realize that's the new market for these particular shares. The market will always find equilibrium. If nobody comes in and actually interrupts the market, it will naturally find an equilibrium. That's just basic supply and demand. So that's all you have to do. The fact that they're not willing to do this is why I know that they don't really believe in this play. And this has really become like a YouTube social media thing, but there's really not a play here. And so anybody that is in this play, you know, people online saying they got this many thousand shares, I wonder what you bought in at. Because if you bought in the 15s or the 20s, you may want to look to get out of the play, because you can get a good 25-30% return. If you bought into the 30s, you may want to try to figure out how you can get some gains and keep it moving. But a lot of people bought in here on this big green bar, right? They bought in here, and then what happened? It immediately sold off. Then they pushed it back up here to the 60s again, and it sold all the way back down. So what happened to all the people that bought in here in the high 50s or low 60s? What happened to it? When it sold down, did they just buy more? And so this is what you got to understand. This squeeze is already over. Now, could it potentially have a one-day run, and not really a one-day run? Let's say maybe like a 1 hour run where it might move up to $100. It might move up to $200. It could potentially do that. But I don't see this going to $1,000. Why? Because y'all don't want to buy this at higher prices. And the actual market and the chart is exposing your inability or your lack of desire to buy this at a higher price. So you can make a million YouTube videos about it. Doesn't matter. It's not being represented in the market because we talked about before, the market will show you who you really are. Okay. So that's why the narrative has turned into there's going to be some type of, government regulation that's going to move this up. Well, the regulation has taken place. It hasn't moved up. Right. Or they're going to margin call these particular brokerage firms and it's going to move it up. Okay. If you believe that, I guess you just sit in a play and wait for that to happen. Then if that's going to happen, then you don't have to worry about the day-to-day movement because you already said that nothing's going to happen until these particular brokerages get margin called. That can happen 10 years from now. You don't know. Right. They keep adding more and more liquidity to the market. So we don't know when that's going to happen. OK, so the narrative is that something external has to happen for this to get squeezed. So the reason why they've created that narrative, because it means that we can just keep pushing this can down the road. Well, in reality, the easy way to quote unquote squeeze this play up is for everybody that is in this deal, that is a proponent of this, that believes it's going to happen. Set your ask, right? Sell all your shares and then set your ask of $500. Be willing to buy AMC for $500 a share. Sell your particular position and then turn around and buy it back at $500 a share. What would that do? It'll push the price up. So then if everybody's going to get margin called because the price goes higher, then that's the easy way to margin call it. Because like y'all said, it's going to 10,000 anyway. So if I'm buying at 500 and it's going to 10,000, I don't care that I bought at 500 because it's going to 10,000. So if I really believe that, that wouldn't be an issue. The fact that everybody wants to buy in under $100, but they want to get they want to get this massive exponential move, shows me that they want somebody else to make it happen for them, which, like we talked about before, that has nothing to do with the market. That is their belief system. That is something that they are invested in from a psychological standpoint, to where I don't make it happen, somebody else makes it happen, and I get the benefit. Because the same way they can jump on these YouTube videos and watch these YouTube videos, they should be able to figure out how to move this up. But you have to believe that AMC actually is worth more, so you're willing to pay for it at a higher price to try to force the move up. So then therefore, instead of somebody else doing it, you are now going to create the leverage in the situation. Right? So what we don't want to do is we don't want to ramble. We don't want to belabor the point. I want you to understand is that this particular short squeeze is over. Why? Traditional resistance on this play was 35.36. It moved up to 60 because of phenomenon. We saw that once it hit 60, nobody wanted to buy it at 60. It moved back up to 60 again. Nobody wanted to buy it at 60. There were not hedge funds manipulating this. You don't want to buy it higher than this, because if you did, you would do it. It traded here for so long because they couldn't find new buyers at higher prices. That's what the chart is telling us, right? Now they can say, well, David, you're misinterpreting the chart. I would ask them to come with another analysis that's kind of based on how the market actually works. It's not reptilians underground and manipulating the stock market, right? Just come with an explanation that's based on how the market actually works. Okay. So what we're seeing is that once it hit $60, they couldn't find more buyers at a higher price point. And the people that are in this particular deal are not willing to pay this. They're not willing to pay more money. They are willing to make more YouTube videos about it because that's where the money's at, off the YouTube. The money's not in this play anymore. Okay. We may get a 1-day run or a few hours run. This might shoot up to $100 to $200. Right. But then immediately it's going to come right back down because, like I said, is they cannot find buyers of this particular ticker at a higher price. And as the longer this play gets extended and, the hedge funds don't recall it, Amazon doesn't buy AMC, which was a rumor at one time. The federal government doesn't come in and, create some type of legislation that means that they now win and, big capital loses. And, the longer that type of scenario does not take place, the more you're going to have people fall out of this particular deal because they're going to lose their attention span. Because what happened is the hype's going to start to wear off. They're going to get desensitized to it. Okay. So that's my analysis of the play. If you have a different analysis, I'm going to want to kind of ask you those questions that we talked about in the play. You can say whatever you want to say about this play. My question to you is, why won't you buy that $500? And then if you and your group decided to buy that $500, you will push the price up because the market will find equilibrium. Okay. This is David W. Williams, also known as Diamond Dave, the founder of the highest paid part-time job in the world options trading program. And if you want to really understand how to become a successful trader, I can't guarantee you success, but what I won't have you doing is chasing plays that don't make fundamental and technical sense. That's one thing. I can't guarantee that you're going to make $1 million in the market, but what I can guarantee you is that if you get into our particular community and you kind of allow me to teach you some of the basic fundamentals of the market, you will not be chasing plays that don't make fundamental and technical sense, because I don't engage in nonsense. Okay. This is David W. Williams, also known as Diamond Dave, the founder of the highest paid part-time job in the world. Talk to you later.